Hello and welcome to another episode of the Investing with IBD Podcast. It's Justin Nielsen, your host, and it is January 29th, 2025. It's a Wednesday. We're coming to you live on YouTube as we do every Wednesday, live at 5 Eastern. So it's going to be a very interesting discussion today because we had a little bit of a destruction happen on Monday, but helping us walk through it and some strategies that you might be employing in order to protect yourself. This is kind of our protection episode. And we got Matt Caruso coming back on the show. Matt, of course, is the CEO of Caruso Insights, which has a lot of educational information and really kind of walks people through how to do a lot of things in terms of investing. So welcome back to the show, Matt.
Thanks so much for having me. It's always a pleasure, Justin, every time.
Absolutely. A pleasure having you. I always say that, you hold a special place in my heart because it seemed like a lot of times when it was like my first time doing the podcast on my own, you were the guest, and it was like, oh, this is easy. If all the guests are like this is going to be no problem. And then when we went live, you were the first one. It's like every time we're doing something interesting or new, you seem to be there. So we appreciate you always making it easy on me.
You got it. That's what I'm here for.
Okay. Well, let's get right into it. I'm gonna go ahead and share my screen, and we can talk a little bit about, just to kind of open this up, that Monday was ugly, and look, we had this ugly day on December 18th, which was after the Fed. And we had a Fed day today, so maybe we can talk a little bit about that later. But the interesting thing about this one was how quick and how ugly it got for certain segments of stocks, and I'm talking about some 20% losses in just a nanosecond. So let's talk a little bit. Of course, the news over the weekend. I mean, this actually came out Friday. Was about DeepSeek from China, and AI has been the theme here. So a lot of people were looking at DeepSeek and some of the claims that they were making in terms of how they were able to do almost as good as ChatGPT and OpenAI with a fraction of the cost. And for a lot of people, that kind of shook them, saying, oh, we have to change our models of how much people are going to need to spend on the power grid, the energy efficiencies, the cooling, the chips, all of those things. It's like maybe if it's really efficient, they're not going to need as much. So what was your take when you were ready to start trading on Monday and things had shifted so violently?
Well, so this was like just a good reminder where what the market's going to do and what's rational are two different things. And so much in the market, this is from my kind of also my experience as a market maker for many years, is when news hits, when something changes, so much depends on positioning more than what the fundamentals are, because especially when everyone's very long, very concentrated, it's sell first, ask questions later. Everyone knows there's only so much liquidity to exit. There's people who are going to actually even press on that to try and take advantage of people who are caught off guard. So it's going to be a fast move. So I think you have to kind of approach it in two different ways. One is what are the real implications of what's going on? I mean, like past 10:30 a.m., like what should I think going forward into the future? And really, like, what's my battle plan going in at the market open? Those are the two different things. So for myself, and I know we're going to get into that a little bit later, but especially when stocks start to get extended, this is also a really good reminder. It's not really the past earnings, past sales that matter. I mean, we use those to find companies that are doing well and performing, but so much of what's in the current stock price is all future assumptions based. And the more stock rips to the upside, it keeps going and going and gets extended. Well, they're cooking in some pretty excited assumptions into that stock. So if anything comes out that challenges those assumptions, and not like just someone's opinion, but something like this that can really rock the boat, that really does have the potential for a dramatic move. So that's what we saw. It was just it was amazing. I think I read somewhere that the drop on Nvidia was the largest one-day market cap drop of a stock in history. Obviously,
right.
That's
and again,
than it used to be, but it was a wild move.
As you're getting multi-trillion-dollar stocks,
yeah, exactly.
A percentage. I mean, let's just put this in perspective. It was if I can get there,
17%, I think.
Yeah, so almost 17%,
Mhm.
and once you get to be a few trillion, yeah, that's gonna leave a mark. Um, well, and before we get too far, because you brought up extended, and I also completely agree with you. Again, some of this valuation and the speculation of what the future holds. I mean, this is an issue with earnings reports too, right?
Mhm.
If people are looking at guidance and then you all of a sudden come out and you change your guidance, or
Yeah.
something shifts in the earnings report, we get those 4 times a year for every company, and it can really kind of change how things look. So I guess there is this, you mentioned especially being careful when things get extended. So uh, can you define what extended means to you?
So I use a couple of metrics, but I always like my work always centers around trying to simplify things. So one of my favorite tools is really just the distance from the 50-day average or the 10-week
Hmm.
average. What's interesting is every stock really has its own flavor of that. The more volatile stocks will go get more extended. The less volatile stocks less extended. But like in this case, it's interesting because Nvidia had already been somewhat lagging compared to some other stocks. But if you bring up stocks like CLS or GEV, you have to look at your stock individually, and you also have to look at the group that it's in, because
Hmm.
sometimes there's the pressure on the individual stock, but there'll also be the group pressure. So if even if your stock is not participating tremendously, like Nvidia was kind of lagging,
Yeah.
but it was part of that AI group. So if the group it's associated with is very extended on its own, that's something you also have to pay attention to. So for me, that's my favorite metric. I have some others. I like to use Keltner channels, which is a technical tool,
Hmm.
which is similar to Bollinger Bands. That's another one of my favorites. But just to keep it simple, to highlight the important deviations, it's really that distance from the 50-day is my primary way to do it.
Yeah, and certainly one of the things about Keltner channels or Bollinger Bands is you kind of have this envelope of the norm, right? Standard
Mhm.
deviation, whatever you're using as your metric, that kind of lets you know when you're at the top of it. Yeah, you're a little
Right.
bit, extended from the norm, and when you're, lower in that envelope, you're maybe a little bit, you know, I guess that's more important for like mean reversion type trades. But I guess there's also the other thing. Sometimes these stocks, if you're just looking at those channels sometimes and you're like, oh, it's at the top of this channel, some of these can go well above where you think they can. And on the flip side, they can go well below,
Right. Oh, yeah,
some of these
absolutely.
channels. So, like, how do you kind of handle that when things are already beyond their norm and then they get even more so?
That's something that was always, I think it's a struggle for most growth investors because, we're investing in these companies because we think they're disruptive and they have all this potential. So as it's going up, it's kind of confirming what your thoughts were, but at the
Hmm.
same time, it's becoming susceptible to these drops. So you kind of put in this catch 22 situation. If I sell the stock because it's extended, I miss out on the upside, but then I can avoid the drops. So for myself, the way I've kind of gotten around it is there's really a couple of questions I ask myself when I see a stock getting extended is one, do I see a runway for much more? Is the stock acting well, or is this later? Is this showing like climactic top action, or even like the valuations getting very extreme based on, let's say, there's no fundamentals, like for example the quantum stocks and the rest.
Yeah.
But also for me, the only way that I was able to kind of have my cake and eat it too was through options. So I'm not a big options trader, but in this case here, like I like to keep it very simple. I think of buying a put as if buying insurance.
Hmm.
And the good thing about the way a lot of these leading stocks act is it's always like the saying, stairs up and elevator down. But that
Right.
that lends itself very well to options, because options you want to protect against a quick drop. That because you only want to be in options when you feel you're susceptible to a drop, because obviously like any insurance, it's expensive to have insurance for no reason.
Hmm.
And so that's the way I've been able to kind of mitigate that. So for example, like I had Palantir, in Q4 last year, and I forget the price of sales that we finally got up to. If it was like 70 times price of sales, which is a crazy number. And I eventually sold it into strength. But on that breakout, especially after earnings, when you have a catalyst, you want to give it chance, time to really work. So if you see November when we had that breakaway move, it was really only once it started getting up near $70+ that I start to kind of decide to kind of take the money and run. But along the way I mitigate that, if I feel there's really some extension, I'll buy some puts a little bit out of the money. That way the cost is not too expensive. But if we get a surprise drop like Monday, I can survive. One, it's not as painful, and two, it gives me time to kind of figure out what next steps are. Is what happened real? Is this just a short-term positioning? Is it a news event that's passing and we can go back the other way? So I've really you have to look at the more concentrated you are, the more dangerous it is when the stocks get extended, because it's all about the portfolio impact.
Right. And so let's kind of break this down a little bit, because again, this really does come to that protection side of things. A lot of people are so focused on offense and how can I get more money out of this stock? They don't think about the drawdown side, and that can be devastating sometimes, where you're making all this money, but what good does it do you if you don't keep it? So you mentioned that you're using options, you're using puts. So are you just buying a straight put, or are you doing spread trades or anything like that?
I like to keep it. For me, it's more about the timing of when to put the options on, because again, you want to it's kind of a straight put buying. Mm-hmm. And I think it's important because I just had a client call where we were talking about this subject actually just this past weekend. So it was unfortunately good timing. But I was just saying, like when you're on the trading desk, like when I was earlier in my career, a lot of desks focus on VAR, which is value at risk, which is a 1 day metric. Like what's a really 1 day bad event that can kind of come and hit you? And that's something you need to think about, because if it's a multi-day type of process, you have time to work off your positions. Like if let's say, you think the trend is changing, you say, okay, I can start to eliminate this stock. It's in those dramatic 1 day moves where you don't have a lot of time for positioning that it's just so dangerous. So that's why I like to just buy puts when things are extended, because that's when you're at most risk for those very quick drops to come against you.
Right. And so are you looking, you mentioned that a lot of times you're looking at slightly in the money. So are you kind of going for like a 50 delta? Do you have kind of a rule of thumb in terms of that? And then also, what kind of time horizon are you giving yourself? Because of course, if you're going with a weekly option, that might be appropriate if you just need short-term protection for an earnings announcement. But if it's like, oh, this is extended and I could see this having to do a base that lasts 7 to 8 weeks, well, then you might need to get a little bit further out. So do you have any kind of set rules, or are you just kind of, going by feel and your knowledge of, where the premiums are in relation to your size?
So I think it's important. I primarily want to use this approach for a stock that I think has the capability of going for an extended advance, like a real, typical IBD, like a leading type of stock. Mm-hmm. And so if you look back at a lot of some of the best advancers over time, they always have these very quick 5 to 15 days steep pullbacks that will take place. They can be 10 to 25% is like a normal type of scary pullback that will come up from time to time. So that's kind of how I structured myself. So I like to buy puts that are about 10% out of the money, so a little bit lower, so it makes it cheaper, and about 2 to 3 weeks out, because it's really it's not about protecting every downside dollar. Like we're in the market's risky. That's what we're there for. Like you mentioned, if you're always we were talking before the call, if you're always hedged, there's no point in even being in the stock anymore at a certain point, right? But it's really about, okay, if I buy protection, let's say 10% out of the money, there's a couple of situations. If the stock kind of just consolidates calmly or comes down 5%, everything is fine at a small cost of insurance. But if there's a more dramatic pullback, like we saw on Monday, that's really where like a lot of the value comes in, and you can think clearly, and then you can adapt to the situation.
Yeah, and I think that's a huge part, because a lot of times it's almost more about being able to think clearly, because look, if you're very heavily invested and you have a situation like Monday, on that opening bell, it's really hard to not be emotional and just say, oh, here's how much I'm losing. Here's the dollar amount, and that's a lot. That was unexpected. And if it just kind of takes a little bit of that pressure off, then you don't feel like you have to fire sale.
Like I started my career in 2008, like January 2008. So it's kind of, baptism by fire, like they say. It was just like how bad things can get, and in a way it's a blessing, because what I learned early on was like never freeze. Even if you're uncertain, do some selling, take some action, because it kind of unlocks your nervousness or your just that feeling to kind of, I don't know what to do, when you lock up and then you really miss the opportunities that you should be focused on. So like I was even sending some, pre-market like client emails out saying like, hey, take action, then, breathe, think clearly, and then after take action, and just make sure you keep moving and thinking clearly. It's almost like a combat scenario. You have to really keep your head about yourself so that you can keep moving, because it's a very natural human reaction to freeze up. There was a great book I was reading from a trader turned I think neurosurgeon or neuroscientist, about just how there's so many physical elements and chemical reactions in our body. Cortisol gets released,
Yeah.
and stuff that really physically will work against us
Yeah.
when, we don't want that to happen, but it's just a natural part of being in the market. So you really need a process to break that, to fight against your natural instincts.
Yeah. And I mean, to that point, this is why I think behavioral economics is so fascinating. The fact that you had Kahneman and Tversky do such groundbreaking work in economics when they were psychologists,
Right.
It was like, oh, okay, you got you're a psychologist, Kahneman, and he got the Nobel Prize for economics. How did that
Yeah.
happen? But you read their stuff and it's like, oh, okay, I see why, because again, not only are you battling those chemicals, the cortisol and everything else, but just in the way that you frame things sometimes it makes a difference. The math might be the same, but the way that you frame it, hits a psychological chord. So yeah, that's
And what we do here is so unnatural from so much else we do in our day-to-day lives. You
yeah,
really need a real process that's simple to use, that's, pre-planned for, what is some really unlikely scenarios that I've just found over my career happen a lot more often than statistics say they should happen. They happen pretty often. It's like, I feel like every 2 years there's some kind of catastrophe that's only supposed to happen every 100 years. But
yeah, right.
yeah.
Yeah, I started trading in '97. I was told that the .com bubble was a once in a lifetime thing. Then I was told that in 2008. Hey, this is a once in a lifetime thing. And then of course COVID happened, and it's like I've had 3 once in a lifetime things at least here.
Yeah.
So I'm not sure what that means. But I want to get a little bit more into this kind of portfolio construction, because on the one side you might get some positions that are very heavy, but are you ever looking at protecting your portfolio as a whole with something like SQQQ, or something that's kind of index related or a little bit broader, so that you're maybe getting some protection from not just a single stock, but more for your entire portfolio?
So because I've always run more concentrated types of portfolios, I've never liked that, because I've just time and time again, especially when it's a specific group or theme that gets hit, it could be surprising how little. I mean, in this case here, the NASDAQ fell just because of NVIDIA, pretty much, with the
Right.
heavy weight that dragged it down. But if not, if you just would have had some other component names like a Celestica or a Sienna, and they're down 20, 25%, and you're sitting in an SQQ and that is up 1%, it's really like an imperfect hedge. So especially, like I said earlier in my career, so many other things where it was always these very like niche different strategies and things. So like the global hedge in that perspective doesn't work well unless you also have like an evenly broad portfolio. So like the hedge always has to really match like what you're trying to do. So the way I like
That can be
look at it,
difficult.
yeah, it can be very difficult. It can
Yeah.
be, that's why, so I mean, so now there's a lot of these kind of like individual stock inverse ETF stocks that are listed, like inverse Tesla or whatever, if you people can do as well. But for me, what I like to focus on is what's the risk for the stock, what's the risk for the theme, and what is just overall portfolio exposure. Like even if a stock is very risky, it's very extended, but I'm 70% in cash. Well, the majority of assets are protected in cash; they're not exposed. It's kind of like the speed of a car. The faster you go, the exponential the impact will be. It's not like a 1-for-1 relationship. So as you kind of get into concentration and exposure, if you're on margin and you're concentrated, well, if something goes wrong, it's going to be like much more painful than if you just have an under invested broad portfolio. So that's the way I like to always frame and look at the big picture along with the individual stocks.
Yeah. And so let's talk a little bit about, just so people kind of understand your mechanics here, how you're very comfortable, or at least you're comfortable mitigating the risk that comes with very concentrated positions. You've kind of, I'm sure, probably worked your way up to that.
Yeah.
Sometimes that takes some getting used to. How concentrated do you get in a single stock?
It's definitely a tolerance thing, and it's really not a one size fits all. Like for everyone, what may feel concentrated for one doesn't for someone else.
Absolutely, yeah.
But for myself, once I get to about like 50% of the account in one stock, I start to feel the heat a little bit.
Uh-huh.
Anything over that, I'm only going to be in excess of 50% if I have hedges on, or there's really like a very tight stop on a recent ads that are working in my favor. So
Hmm.
like most recently going into Monday, I had GEV, which was a big position. I'd been working on that since last August. I've been building that position. And so that was originally like about a 40% position. But then through December, as we were so strong and I saw all the kind of the news building in favor of it, that became like a 70% plus position for me. So that was like a really sizable position. But as we were getting to earnings season, I had hedged for earnings. And once earnings passed just a few days ago, fortunately I saw, hey, this is now fairly extended. And earnings weren't like a blow out of the park type of earnings. So to me, this was susceptible for a move back down to the 50. Didn't think it was going to happen in one day.
Right.
I did buy like about 1 month out. Again, I was using the model of how a lot of these stocks will tend to have this 2 to 3 week pullback down to a key average. And that's how I was able to kind of really protect what was a big position. And I probably wouldn't have been, in this case here, being so aggressive kind of helped, because if it was a smaller position, I probably would not have hedged to the same degree. It was really having that concentration.
Yeah.
Really pushed me to make sure I had the protection in case of a worst case. So although Monday wasn't very nice, it wasn't as bad as maybe someone would have thought if they just saw the positioning.
Yeah. And look, just in full transparency here, I had GEV. I wasn't hedged. It was a little bit of a smaller position, so for me, and I'm using a cash account, retirement accounts a lot. So for me, a lot of times it just makes a little bit more sense for me to just raise cash. But I got whacked, and not just from this, but I had VST as well. I had MTZ, which is in a heavy construction, but that was down, however much it was down. So so how much again, a lot of times I kind of think of it as getting to my sleeping point, where, oh, okay, this is, for a normal move, I'm going to be able to kind of withstand it. Of course, this was a very abnormal move, down 20%. But what level of hedge did you have to do to kind of get yourself to that level of comfort? Did you hedge the whole thing, or half, and that was enough, especially for a position that large?
So that's why. So a lot of things come into it that you want to start to think of as you're working your positioning. Like it seems like it is a very big position that built up only over time, slowly. But there was one reason for that as well, as being a GEV, $100 billion. It's a spin-off of General Electric. It's a very institutional grade type of company. I would not have that positioning in a small cap that has a software with very little revenue. Like I think that makes a big difference, because one is what is a worst case scenario is going to be much less, and also the cost to hedge, the cost to buy puts is much less expensive on a GE Vernova than it would be for one of these volatile small caps. So it makes it reasonable. So one of the benefits
of spreads sometimes.
Yeah,
you can drive a
exactly.
truck through some of those spreads, because there's two elements, right? There's that implied volatility that is one of the metrics that goes into the option premium, but there's also the liquidity. If you don't have much liquidity, it's hard to get people to step up, market makers to kind of take that risk, and so you can have a very wide spread because they're like, okay, I need to get paid if I'm going to be taking this risk, as you well know as a former market maker.
Yeah, but I think that's why it's a good example, because this is an extreme example in terms of concentration for me. Even by my, usually for me, what's comfortable is like a 20-25% position in a stock. That's like where I feel like I want to be heavily invested, and that there I feel like, okay, let's let the stock work at this point. Like it's very abnormal for me to have this type of concentration, and one of the reasons was because of the profile of the company, and two, the cost of protection is very inexpensive. So so I this had gapped up to around 430 after earnings. I was long the 415 puts. And this is an interesting kind of benefit of hedging as well, where you could kind of turn around and be more aggressive. Is after that big drop, I had a big profit on my puts. So I was able to
Yeah.
kind of like harvest those and de facto lower the average cost basis of my trade.
Right.
So that once that drop happens in this kind of a scenario, then you ask yourself, like, what do you think the future is of the stock? If you still like it, you basically get to lower your average cost and then sit in the same position and, hopefully ride the stock higher a second time. So,
Mhm.
so that big drop actually gave me like a really good opportunity because it kind of happened so quickly and I had that hedge on. So there's, hedging, a lot of people think of it as kind of like, oh, it'll reduce profitability. It goes against my stated goal, but done properly, rather than panic when the pullback happens. I mean, how many times have you said like, oh, if it gets down to that 50-day, I'd love to buy the stock. And then it gets to
Yeah.
the 50-day, but so is every other stock. And you're in panic saying, wow, I have to start selling stocks.
Yeah.
And you sell the stock you wanted to buy. And looking back, say, oh, why didn't I buy that stock? So I found that hedging can oftentimes actually increase profitability because it has you do the right thing at the right time versus that negative emotional reaction at the wrong time.
Yeah, absolutely. Now let's talk a little bit also because, again, I think you addressed very well how you had a large position on this. It was extended. I mean, GE Vernova just looked extended, right?
Yeah.
It had been kind of ramping up. I mean, we can take a look real quick at, some of the metrics here. It was what, 25% above
Yeah, for a
the
utility
50-day.
grade company, that's very extended.
Yeah.
Yeah.
So, so yeah, 25% above that 50-day moving average line that you mentioned as one of your metrics. So yeah, but let's also kind of talk about, we're in earnings season. So what's your kind of playbook for earnings? I mean, we had a whole host of them. I personally have a little bit of Service Now. Not down as much as it was. It was down like 10%, 11%. But I have a smaller position on this. So at 3% position, I'm not going to cry to anyone. A 10%, I can withstand that. So
Yeah.
with something like this, I mean, this was kind of looking. I mean, it was a strong move out here. But how do you kind of do the earnings protection, especially since this is something that comes around again 4 times a year for every stock?
Yeah.
And what do you do?
So you really need like you said, you can't ignore it because it's always going to be back. I mean, there's even stocks in between those 4 times. It's like you're almost always dealing with some kind of an earnings report. And if you look actually at 2024, like Salesforce.com fell 21% on earnings, which was, I mean, Dow Jones components. If you look at, last May, and even if you look at Palo Alto Networks, PANW, that had like almost a 30% drop last February of the box.
This was,
but yeah,
right
that
here.
big red cat, that was a one night overnight. I mean, this was again like $100 billion plus company. If $100 billion plus company in a Dow component can drop 20 to 30% overnight, it really has to make you rethink what's possible. I think part of it is HFTs and algos are more violent than what it's ever been before and all that kind of thing. So
HTFs, you mean like high frequency trading?
trading,
excuse me. Yeah.
That's right. So they really will kind of pounce on a stock of weakness and exaggerate moves in both directions. So the first question I always look at is what percentage of my account does it represent? Like you said, if it's 3%, you can't get too hurt. It's not that big a deal. In that case, I'll ask myself, do I have enough of a profit to at least withstand the expected move? Like the options market will always show the expected move, whether it's 7% or 10% gives you an idea. And do I have a profit to pay for that? So if I'm up only 3% and there's a 10% expected move, I kind of feel like I'm just like rolling the dice on this outcome.
Right.
I always
and let's just real quickly define expected move. So again, you can use the options market to kind of say, okay, this is what the expectation is in terms of the implied volatility. A lot of times it's the cost of the straddle. So you just take the at the money call, add the at the money put, the premiums of both, and that kind of gives you a sense of the expected move. You go with the nearest expiration to your event, I guess. Yeah. And so do you, some people apply a factor to that. What do you do to kind of come up with your expected move?
No, I usually will rely on that. I figure, the options market they're pretty efficient. Like their business is they're like the insurance underwriters. Like they have a better idea of how to do it than me. That's not my specialty. So I kind of defer to them. But again, like if they're going to be wrong, I need to know what my exposure to the stock is. Like how painful will it be for me? If it's a 5% position, it's not a big problem if they're wrong. But if you're in Salesforce or Palo Alto and they fall many multiples of the expectation, and it's a 25% position, it's a big problem. So whenever I get past really like the 10% of my portfolio, again, I want to buy puts, like at the money puts before earnings. If I have enough profit to cover it, the way I like to teach it is, picture yourself as a business person running a business, and you have this big risk event coming up. You're going to sit down, do the math. Like no one ignores taking an insurance on their home, like fire insurance or earthquake, just because like I don't feel like paying. You say no, this is a valuable asset to me. I have this potential risk event that's coming up. I wanna hedge against it. I want to make sure that I have insurance. That's the way I view earnings reports, because it's just you have this big gap down, and then again there's the capital loss, there's the mental frustration. So for me, it's every quarter it's an opportunity to reassess my portfolio. If I have a stock that it costs 4% to insure it with a put, if I don't feel there's more than 4% upside in the next 90 days in this company, why would I be holding it through this risk event in the first place? And if I don't have more than a 4 or 5% profit to pay for that, why would I hold this position in the first place? So I try and take off my trader's hat and just put on like a business person's hat and be like, okay, well, dealing with this uncertain situation, how do we look at these outcomes? And that's the way I approach it.
Well, and so one other aspect here, I feel like especially in the last couple of years, we've seen, and look, this has been really since regulation, fair disclosure came out in the aughts. Earnings just sometimes the moves are just so much more. And now that we've got these $1 trillion companies, you would think, oh, well, you're not going to move a $1 trillion company, but I mean, we saw, we've seen them like up 20% or more on earnings sometimes, or down, that much. And so I guess the question here is like for some of these stocks, it seemed like the only time they moved was on earnings. It was almost like they would move on earnings and then not do anything much until the next earnings report.
Those stocks, they're so frustrating. They're so frustrating.
Yeah, so if you're hedged, and you kind of don't participate in the move as much, then does it become like what's the point? Or how do you kind of avoid that situation where it's like, or is that just kind of knowing your stock, the personality?
Yeah, well, it's like when I mean hedge, like if you buy a put, you're paying the cost of insurance, but you get the upside. You get the upside less the put. So you do, if it's one of those like they gap up, do nothing, gap up, do nothing. Well, at least if you're just paying your insurance, you're getting the gap up. Less the cost of insurance. So there's that. But for me, that's part of also going into the report. If I don't have a profit, once you kind of put these small rules into your process, and like they should be very simple. Once you have these small rules, like if you don't have enough profit to pay for the insurance for this company, it probably is one of those stocks like you just mentioned. It's just reacting to earnings. So then basically you're just taking on a lot of it. You may think you know what's going to come, but really you're rolling the dice because no one really knows. Nothing good doesn't have consequences. Reg FD was great intention. Everyone gets the information at the same time, but now we have to deal with these 10 to 30% moves up and down. But it's a reality that we have to really address because it's just way too dangerous not to.
Mm-hmm. That's awesome. So any kind of closing thoughts on the protection side of things? I think you've covered again what you do when you do it. So again, whether it's extended or earnings related or just a size issue, where you feel like you need that protection. Any kind of closing thoughts on the protection side of things?
I think it's just look at it again more from an insurance perspective. Keep it simple because options can be very overwhelming. People are gonna, if you like look up education, it could be, do we put on this spread and this calendar and diagonal,
learn the Greeks and
payoff charts, and you're like, what are they talking about? So like I just really try and simplify it. Like everything we should do should be as simple as possible and no simpler. And just really say, how can I protect myself against these events? Either I got to scale down to an appropriate size, or I need to just buy a simple put and then factor that cost into the cost of doing business. That's the way I do it, and keep it very simple. And that way you can sleep at night and not have to worry about those outliers that Monday or just general earnings that can really, knock in your portfolio.
Yeah. I should also mention that you do have a seminar coming up or a
Right.
workshop this weekend. So you're going to basically be talking about a lot of things in your hedging strategy. Where can people kind of get that information?
Yeah, that's
Uh,
at carusoinsights.com. And again, the real point is kind of to teach it as a stock investor using options for protection rather than options and stock investors totally lost. So it's really
right, right,
about
right,
kind of
right. Yeah, yeah.
the implementation of everything we're talking about is really what we're going to be doing.
Options for stock investors.
Yeah, I guess.
Yeah,
Yeah.
exactly. So let's go ahead and shift gears a little bit because I do want to kind of cover a little bit more about the current market.
Hmm.
And one of the first questions I have, again, when you see kind of this bad break here that we had on December 18th,
Hmm.
kind of a fairly ugly day here on the beginning of January, and then again another one. Does this ever give you a sense in terms of the market that we just might be um, in kind of a choppy period? And does that kind of influence how you're going to approach things? Or is it, are you just more focused on your individual stocks versus the indexes?
So again, I think you know Ralph Acampora. You've had him on the show in the past. I call
Yes,
him the
right. Yeah.
godfather of technical analysis. I
Hmm.
remember early in my career, he would tell me, Matt, people love these top-down tools. He's like, I'm a bottom-up guy. Like I like to look at all of the individual stocks instead of just look at the index. And that had a big impression because up until that point, I hadn't looked at it that way. So sometimes, I like to approach it both ways, but sometimes the index like this can look so choppy, so directionless. But underneath the surface, when you go stock by stock, it's really a matter of some groups are very strong, some groups are very weak. And so there's still opportunities. And other times the market that the indexes are choppy and just things just look awful everywhere. So it kind of
Yeah.
depends the context of what you're doing. So to dive in a little bit deeper, if you look at all the, IBD does a great job with Market Smith. You can look by industry group. If you're looking at the top groups, and there's many of them from different themes, and there's a lot of great companies. Well, there's opportunity out there. I mean, like as bad as Monday was, it's like you instantly saw some new themes take center stage, some new stocks pushed to new highs. If it was a breaking down of the market, let's say like COVID in March of 2020, like everything was breaking down together. There wasn't a rotation that was running for the exits, but suddenly we saw here a lot of stocks doing well. So to me,
Mm.
this is a market that's adjusting. There's a lot of uncertainties with inflation and the Fed still. President Trump with tariffs and AI. Like it's just people rotating, not sure where to go, but it still seems very much like a positive risk on environment. You just need to be in the right places.
Yeah, to that point, I mean, XLP on Monday, the consumer staples
Hmm.
was up, tremendously, which
Hmm.
again, you would normally expect that. Okay, there's fear, people go hide in kind of the staples that are a little bit more stable and everything. But then, the next day it was down pretty considerably. It was kind of like, oh, I guess maybe they weren't interested in that. And then
Hmm.
you also had, just one of the things we've been talking about on IBD Live is, I mean, RSP, which is the equal weighted S&P 500. Well, first of all, the S&P 500 just came down to its 50-day moving average
Right.
line. And then RSP really held up well. I mean, this just
Hmm.
looks like a run of the mill kind of tight area. You don't even see the drop on the equal weighted S&P 500, kind of, telling you how this was very targeted.
Yeah.
In fact, on Monday, advancers, outnumbered decliners on the NYSE. So it was very strange how, again, the heavyweights, the trillion-dollar companies of Nvidia, were targeted and really kind of brought the indexes down. But um, there were a lot of stocks out there that looked just fine.
I agree. I mean, if you looked at MDY, which is like mid caps, or
Hmm.
IWM, which are small caps, if it was a really bad break of the market in general, okay, I mean they're not doing phenomenally, but you didn't see bad breaks in the broader
Right.
groups. So for me, it was more of a people said, oh, we have this concern about Nvidia. Where can I put my money? Where else in the market I want to be invested? I just maybe want to rethink Nvidia at this moment.
Mm.
So to me, that's a very, I think, strong. I mean, to withstand a hit to what was kind of like the general for the past couple of years, and then the market
Right.
bounced back. To me, that's a tremendous amount of strength. So I think
Yeah.
the market's positioning very strongly here, and it's just a matter of just being able to move around with these rotations.
Yeah. Very different. Like again, December 18th, you know, all of these indexes were,
Right.
were down a lot more. It was kind of a universal break on these, as opposed to this where it was very, very fractured and bifurcated.
But you know what?
You
Like
know,
if you can avoid if you can avoid or minimize, the losses on those drops, they are the best time to analyze the market because all of the next key themes are going to show up during those weak periods. Like if we go back to GEV, just real quick, like the reason like I was already long from last what was it, August, September, as it was coming out of that first base. If you look through that like December period when the market was getting whacked, like this was starting to work itself already back to 52-week highs, like that end of December, early January. So this was very
mhm,
strong when the rest of the market was very weak in the middle to late December. So just so looking at what happened on Monday in the past couple of days, one day doesn't make a new trend, but you really want to be attentive to who can push to new highs because if you can survive, if you can stay strong when the market's weak, that is it doesn't, I always say it doesn't matter what opinions are. If a stock doesn't sell off when the market sells off over a persistent period of time, that's a tremendously strong stock. There's either just no one wants to sell or there's tremendous demand. There's no way
yeah.
to hide that.
Mhm. One of the other things that we were kind of talking about in terms of stocks is, um, again, with the whole AI thing. Look, if you make it cheaper, if you're more efficient, there are a lot of those stocks that are going to benefit from that. The kind of the downstream use cases of AI, which a lot of companies are still trying to figure that out. How do we monetize this? How do we make money off of it? And we certainly saw a lot of software companies hold up very nicely.
Mhm.
Any in particular that kind of you mentioned CRM already, as one example. Again, a Dow component. Monday. I mean, this thing is up tremendously because
Mhm.
again, this is a potential beneficiary. But any other stocks in the software space that kind
Yeah, it
of
was
really caught
interesting.
your
So
eye?
like that whole kind of marketing world. So like to me, like there's again, you can always pick your poison, how aggressive you want to be. I think Salesforce is the more conservative answer. The midway answer would be HubSpot, HUBS, which was also very strong. It's kind of a competitor to CRM. Uh, you'll see that's a
Mhm.
similar amount of strength that came through. I mean, this broke to new highs. Imagine the market's down 3%. This is pushing to new highs. And also Clavio, KVYO, is a recent IPO, and they're kind of in the marketing business, communications business to clients and all. And they also have a very very strong stock, but it's a little jumpier, a younger, maybe less liquid, but also just great action going into responding from that weak market.
Mhm. And then also another area again that just seemed like eh, it was a shrug, like
Mhm.
nothing's affecting us here. The retail space just really
Wow.
seemed um, overall unaffected. I haven't looked at XRT, but yeah, I mean XRT, the Spider S&P retail, um, you know, doesn't show anything, and we've had a lot of different retail. I mean, Walmart. I do have a position in Walmart. I mean this broke out on Monday.
Mhm.
Um, you've got Costco. Another retailer that had a very strong Monday, got back above its 50-day moving average line. Any others that kind of caught your eye in the retail space?
Yeah, and I think also, looking at who's surviving well during a market sell-off is a good sign. I think the reason the market is holding well with retail being strong is showing you that the consumer is strong, and that's a good sign for the economy. But there's a GLBE is an interesting company. Again,
Mhm.
younger company. I always prefer kind of the higher growth type names, but they facilitate like cross-border payments and all the rest, and they're doing great and good volume on that breakout. Interestingly, Shopify is a part owner of GLBE, and they also look good, very broad based. Um,
Right.
and that was a very strong move on Monday as well. And individual retailers like ONON has been very, very strong. What I like about ONON is this is strong as Nike has been very weak. So it's not
Right.
so much that like, hey, we're just going up because it's a strong, a footwear market. Like, the biggest player in the room has been under tremendous pressure, and ONON has been able to win in that environment. So that now with maybe the industry strengthening as well, we'll finally see ONON stretch to the upside. So it's been some really nice, interesting rotations.
Yeah, I did. I couldn't help myself. I got a little bit of this myself, but I didn't go too heavy on holdings because I have Deckers that I've been holding for a while.
Okay.
So again, this kind of comes back to that whole concentration side. You have to be careful, not just your concentration in a single stock, but if you own a bunch of
Right.
shoemakers, or a bunch of, Chinese stocks, or again, name your theme.
Hmm.
There is that kind of risk. And one of the things you and I were talking about, again, part of diversification is that whole uncorrelated assets. There were a lot of things that broke their normal correlations. You had
Hmm.
utilities. Here's a utility ETF, Utes. This this was going along with the market as opposed to how utilities are usually that defensive play. So, how is it that you kind of make sure that your assets, your stocks aren't too correlated with each other?
I think it's really important to watch the day-to-day action of your stocks and how they react with each other. I mean, to your point, there could be linkages between your stocks that you would never expect. So, if you're, for example, like, the retails you said were strong, like, recently, like air conditioning type companies, like, ventilation type companies have been very strong. It's all been tied around this AI theme and infrastructure. So if the regular movement of the company doesn't make sense, like, instead of before patting yourself on the back saying like, oh, I found this needle in the haystack, there's probably something that you're not aware of that's actually driving the company. Like, if you bring up a
Mhm.
CLS, Celestica is a good example. They have a couple of divisions. Actually, reported well tonight. They're up strongly, but they have a couple of divisions, and their smaller division, the smaller part of their business was components for data centers. And so up until recently, there hasn't been a lot of growth at Celestica for many years, but now growth has been surging because that what was the smaller business unit is suddenly surged. So if you look at a quick overview of what they do, contract, manufacturer of electronic products. Okay, for healthcare, industrial, aerospace, it doesn't sound very AI related.
Right.
But then, so even just looking at the surface of what your company is, if it's not acting what you would expect for its group or for its character, you got to dig in deep a little bit. And usually investors are going to be really focusing on the key drivers. So this is because of what was a small division's become a big division and the main driving force for the company.
Mhm. Mhm. How do you kind of do that deeper dive there? What kind of sources do you use to kind of understand a little bit? And I love that. I love how you kind of use the chart to kind of tell you, oh, something different is happening here. Now let me go look at the fundamental
Yeah.
side and see, if I can answer the question why.
Well, especially when these big group moves happen, sometimes it's really like a lot of times the companies are going to want you to know, sometimes they have a stodgy business, but like they want a better multiple, so that they'll be like, suddenly, hey, we're servicing AI companies. If you just go to the investor relations site, it's always there should be an investor deck at most well-run investor relation departments, and
Mhm.
just going through that deck, the first 5 slides, you should probably get a good idea of what if they can't articulate it well to you, they're probably not going to articulate it well to other investors, and so you should probably
Yeah.
probably move on to something else unless you're great at digging into the SEC filings. But I always like to really just go to the deck and figure it out. And if I'm really lost, honestly, Google's like, why is Celestica up so much? You'll probably find an article about, oh, okay, it's AI components I didn't realize. Then you can
Yeah.
dig in deeper. But the
Yeah.
investor relations site's usually the best place to start.
Yeah, I do find those investor decks fascinating
Yeah.
sometimes. I it's fun reading sometimes just to kind of learn about,
Can get
what.
carried away because they always spin things so like that's if everything looks so great in the deck,
Right. I
but
was
then
just gonna say
reality hits.
that's the thing is, in some ways they're kind of painting a story, and you're like, oh, if you kind
Mhm.
of buy into their narrative. And I mean, even algos were kind of going crazy because it was like you had all these companies on their earnings reports for a while that were just seeing how many times they could throw AI into, their. I mean, it reminded me of the 90s where it was,
Yeah.
oh, let's just throw .com at the end of our company, and then we'll call that our business model.
Yeah.
So maybe we can kind of end here with, this idea of the projection, because I mean, you have talked a little bit about how this does remind you of the internet boom of the 90s, and how a lot of people are looking at this as, look, you will have these downturns, these blips, this volatility sometimes, for a new technology that people are still figuring out how are we going to use it? How are we going to
Mhm.
what are the use cases? I think that isn't clear yet for a lot of these things. So
Yeah, but that's the interesting thing about about a lot of when something is new. It's so easy to be cynical on a lot of new things, and with reason. You have to make sure that it's not just all like hot air. But if you go back to the 90s, could you have ever imagined what an iPhone would be? I mean, what is even possible to have data streaming through the sky
Oh
like
yeah.
we do now? I mean, was it an unthinkable thing? Or I mean, like now, Musk's going to have soon, autonomous. Waymo's already driving autonomous vehicles. Like, think of every time this technology comes out that is a new platform, it enables so much innovation on top of it. It's unbelievable. So you have to have a healthy dose of skepticism, but you also have to have a healthy dose of almost looking at how the chessboard can move in multiple steps. You want to listen to what management's saying, and then you also want to look at the numbers, and the chart is always the final decision maker. If the management's promising the world and it's breaking down, something's off, but maybe you don't have to forget about it and it can come back a little bit later once, uncertainties are resolved. So I think the 90s is a great playbook. Everyone should be looking at all the leading stocks, how it unfolded, and all the different technologies built, because I think we're probably like inning 1 or 2 of what is a very similar, amazing cycle.
Right. Yeah. And again, it doesn't mean it's going to go straight up. There's going to be a lot of blips and things like this where some new technology comes out and it shifts the players. I mean, you and I, before the show started, we were talking about when was the last time you looked at like Netscape Navigator or, I mean, my dad still has an AOL.com email, and every time I look at it, I'm saying, oh yeah, that's right. I remember AOL. So yeah, it's very, very interesting. But Matt, it was great having you on the show. Really appreciate it. Again, for folks that want a little bit more information on some of Matt's hedging strategies, he's got that. How long is your workshop going to be on this weekend?
Options can get a little bit tricky, but I'm aiming for about 4 to 5 hour workshop. So it's going to really from the basics right up to like really practical strategies coming up this Saturday. So
and also for folks that maybe aren't following you on X, what's your handle?
It's trader_M Caruso. And I'm also on YouTube with quite a bit of content as well.
Yes, some great videos there. You've been on here a number of times, so people can kind of check that out. You're talking about the adaptive relative strength, a lot of things that are very interesting. I really like your take on the market. So appreciate you coming on the show again, Matt. It was great talking to you.
Thank you so much, Justin. Always a pleasure.
And that's going to wrap up our show for this week. Please join us next week because we're going to have Jeff Hirsch back on the show. This is kind of our annual tradition to have Jeff Hirsch, editor of the Stock Traders Almanac, on the show because he goes through the trifecta between the Santa Claus rally, the first 5 days of January, and the January effect to kind of see what projections and decisions we can kind of make based on the January time period for the rest of the year. So he's going to share his thoughts on that, some of the data that he's compiled in that Stock Traders Almanac, and we'll hope to see you next week. Thanks a lot for watching. We'll see you next time. Bye now.